Right now, there is a bill that Republicans have introduced. The House is expected to vote on it today, and that bill seeks to keep rates on subsidized Stafford loans at 3.4% for one more year at least.
And the Stafford loans, these are the main loans that people borrow from the government to fund their education.
These are the most popular student loans, and one of the reasons is because the government pays for the interest on these loans while the student is in college.
And if these rates were not left the same, they would double come July.
Right. So currently they're at 3.4%. They're expected to go to 6.8% in July if Congress doesn't act. Right now, the Republicans this week introduced their own bill. Democrats introduced their own bill. The question is whether both sides will agree.
And the question also being, like, how will we pay for this?
Right. It's expected that one more year of keeping rates at 3.4% will cost about $6 billion for the country. So there is a question about where will funding for this low interest rate come from.
Now, there's also discussion about whether student loans should be able to be part of bankruptcy, whether you should be able to file for personal bankruptcy as a student and basically have your student loans forgiven. Right now, you can't do that.
It is one of the only consumer debts that cannot be forgiven in bankruptcy. You can get rid of credit card debt, mortgages, car loans. You cannot get rid of either private or federal loan debt currently. But there are two bills in Congress right now that seek to change that. There's the bill in the House, there's a bill in the Senate, and what they're looking to do is to make private loans forgivable during bankruptcy. So they're saying if you can actually get your debts discharged in bankruptcy, you should be able to get your private student loans discharged as well.
Now, some of the problems that might come up with that, I imagine, is don't often parents now have to co-sign a student loan, and that could sort of bring the parents into bankruptcy proceedings, it would seem.
There is a question about how effective such legislation would be, because since the credit crunch, really since 2008, most lenders have been requiring co-signers on private loans. In most cases, those co-signers are the parents, and they're vetting them very thoroughly. They're making sure that they have good credit scores, clean credit histories, high income. So these are not individuals who would really be filing for bankruptcy in the future. And the only way that students would be able to truly have this debt discharged entirely if this legislation was to become law is if both the student and the co-signer on that loan file and get approved for that bankruptcy.
So let's look at some alternatives for students out there than these loans that they typically have been taking out. What other mechanisms can they use to help pay for school? Because as we know, so many students they're drowning in debt, and this problem is becoming worse and worse.
One of the things to look at, many colleges currently offer what's called tuition installment plans. Essentially, if a family, let's say they owe $10,000 for the year, rather than having to pay that $10,000 up front, they're able to set up a payment plan where they can pay $1,000 each month for 10 months. That might be easier for some families to handle rather than paying that one lump sum in the beginning. Also, there's no interest rate on this, so it's not a loan. It truly is a payment plan.
And private loans in general, just a little bit of discussion about that. So what are the best bets for private loans?
So currently there are a few banks that are offering private loans that have a fixed rate. Typically they're a variable rate. So if you can get a loan on a fixed rate that's at about 5 or 6%, it is possible. There are a few banks out there doing that. Wells Fargo, for instance, is one of them. You could potentially get a better deal than you would on the federal side. Even cheaper are the private loans that have variable rates. They're currently at about 2% starting for people with the best credit. But the problem for parents is that when rates eventually do start rising, when we move into that rising rate environment, these loans will become a lot costlier. The rates are expected to go up in the future, which means that the monthly payments due on them will rise as well.